Okay, so using the cost method, right? Okay. A company does not have any subsidiaries. Basically, if a company does not have any subsidiaries and the company's purchased an investment and they've purchased some shares and they've got more than 20% of the shares of the company, that generally means that we use the equity method, don't we? Okay. So, in fact, I'm going to show you the cost method here, but we don't actually need it, right? Okay. So, we've got the company does not have any subsidiaries, purchased 35% of the shares of B company for $350. During the year one, B company makes a profit of 100 and declares a dividend of 70. So let's just deal with year one. So year one, we're basically going to go debit cash. No.
Debit investment.
Debit investment.
And credit cash. Oh, done.
Credit cash. And the amount?
50. 50 done.
Okay.
That's right.
You happy with that?
I'll do that.
Right? Okay. Good. Okay, so that's the first journal entry. Second one?
Debit investment.
Okay, are we getting debit investment? Cost method. Debit dividend receivable. Credit. Dividend revenue. Yep. Okay, so the amount was 70,000. You multiplied it by 35%.
You spent more than 400. Spent more than 400.
Okay, happy.
Right,
Good. Well done.
Yep.
Very good. Okay, so that's year one. Anything else that we need to do in year one? No. Okay, so we go to year two. What's the journal entry? Anything required in year two?
Profit for share.
No cash.
No,
Cash
cash
and
and
dividend
dividend
receivable.
Okay, well, good. Debit cash, credit dividend receivable, and the amount is 24,500. Yep. Okay, happy with that?
Yeah.
Okay, anything else that we need to do using the cost method?
Yeah.
What else?
Dividend receivable and dividend revenue.
Okay, debit dividend receivable and credit dividend revenue. Okay, and it's going to be how much? Okay, so the dividend was in year two, makes a profit of 200,000, declares a dividend of 105,000. So 105,000 times 35% gives us
36,050.
Okay, that's all. Done. Cost method easy. What's the value of the investment? 350. You don't have to do any calculations. Okay? Value and cost. Good. Yes. Okay. Okay, so let's just look at the equity method now. Okay, equity method. We're going to have the same thing here. Okay. This here, will that change at all?
Yeah.
Yes. What's going to change? Okay, what we're going to have is, instead of dividend revenue, we're going to have investment. Right? Happy?
Before that, we need to put entry for profit.
Okay, quite right. We also have to
Debit investment, share profit.
debit investment and
And
credit.
share of profit. Of 35,000.
And the amount?
35.
35, you say?
Yeah, 35. Because of the 5,000 divided by the 30%.
Okay, so we've got a profit of 100 and we've multiplied that by 35%. Okay, this is year 2. We're still going to have something like that, aren't we? Year 2. Doesn't really matter the actual order because all of these are going to be put through at year end anyway. So it doesn't matter too much what order they are in. Year 2, we've got debit cash, credit, dividend, receivable. Will that be okay? We leave that as it is? Okay, so we're going to leave that the same. The next one, which is dividend receivable and credit dividend revenue, we're going to change that to
Investment.
investment. Yeah.
That one's a revalue land. That one's revalue land.
Okay, they also revalued land, so we're going to have that journal entry in.
It's 61,000.
So revalue land, we're going to have debit what?
Investment.
Investment
And the credit revaluation.
and credit revaluation.
Of 61,000.
42.
61,000.
So the land is also revalued upwards by 175, so 175 times 35%.
Which is 61,000.
61?
1,720.
Do we have to take up the tax?
Yes, you're quite right.
Who
Okay.
tax it?
So land is revalued.
You could tax it.
That's right, you always have to take out the tax.
48.
That's all. That's all. Cash free.
42,875.
Okay, 42,875, so we've got 175 times 70% to get the after-tax effect, right?
Yeah, that's funny.
And then multiply that by 35%, yeah. Okay, you all happy with that? Any questions?
There is one more thing.
You're quite right, there's one more, okay? Which is going to be debit investment.
And share of profit. Is it different share?
And the amount's going to be
70,000.
70,000, which is obviously 35% of the profit. Okay, profit was 200, so 70. That times 35%. Okay. Profit times 35% gives us the 70. Yeah. Okay. So we've basically gone through the cost method and the equity method. Okay. For this particular situation that we're given here, we should have used this method, the equity method. If I said to you, what is the value of the investment at the end of the second year, you would obviously just add up 350 plus, minus 24.5 plus 35, minus 36,750 plus 42,875 plus 70.
Paula asked you, what's that 30%? Is that 70% or 30% of what the next time see?
Okay, this one here is the land was revalued upwards by 175.
Okay.
We multiply that by 70% to get the after-tax effect of that.
70% of dividend?
43,669.
That's the deferred tax liability. So when we revalue, we always debit the asset, we credit the revaluation, and we credit the deferred tax liability. Okay? So if we want to get the actual increase in the equity, it's going to be the amount that the assets increase by multiplied by 70% because it's the after-tax effect. It's the after-tax effect. Remember, the asset figure will be 175. The deferred tax liability will be 30% of that. And this figure will be 70% of that. Okay. Okay. So if I said that a company does have subsidiaries, what's going to change here? We know that what happens if a company does have subsidiaries? We know that in the books of a company, being the parent, what method do they have to use? The cost method. Okay. But in the group financial statements, what should be used?
Equity.
Equally.
The equity method. Okay. So if I said for the group, okay, we know the equity method has to be used, so why can't I just use those journal entries there? Some of those have to change. Why? Because of the fact that in the books of the parent, they've used the cost method. Now, in the books of the parent, they've used the cost method already. They've put through journal entries which are based on the cost method. So what they've already done is they've already said debit investment, for example. They've already done that one. Okay. They've done that one there. They've also done any of the dividend journal entries. So they've already done this dividend receivable and credit dividend revenue. Okay. They haven't done that one there. They have done that one. They've done this, but in a different way. So debit and credit dividend revenue. Okay. They haven't done that one, and they haven't done that one. Right. Okay, so we can't just simply do this, because this has already been done. Okay? And if we do this, we're going to double up over here. We're going to double up our dividend receivable. Okay? We're going to end up with a dividend revenue and an investment. So we've got to be careful where this has already been done. Okay? So what we want is we want to end up with something like this, but taking into account that this has already been done. Okay, so we don't want to double up. So the first thing we're going to do is we're going to say, okay, we don't need this one. Right? You agree with me? It's already been done. This one here, we have to change. We don't want to have this again. Right? That's already been done, dividend receivable. Okay? So we're going to take that out. Dividend revenue, we don't want that, do we? Because we want to end up with debit dividend receivable, credit investment. So we want to take that dividend revenue out. And if we do that, it's going to cancel out, isn't it? Right? It's going to cancel out. We've got credit investment, okay? What we do if we do this journal entry is that we've already got this, which we wanted. We've cancelled that out, right, by doing this, and we've got that, which we wanted. So what have we done? We've cancelled out this one, and we're left with debit dividend receivable and credit investment. Okay, so what I'm saying to you is that what we need to do for the group consolidation adjustment, we've got to say debit dividend revenue and credit investment. Yes?
So, what if that's 35% of shares? So what if it's less than 20%? So which method we need to use?
Generally cost.
So it's cost on both sides then?
If it's less than 20%, you don't use the equity method. Yeah, less than 20%, don't use the equity method. Only if you have 20% or more of the shares that you think about using the equity method. Okay, it's when you have 20% or more of the shares that you then have what we call significant influence. Okay. If you don't have significant influence, you don't use the equity method. Okay, there's one exception, and that's joint ventures, but that's something we'll come to later. Okay, so you're all happy that the first journal entry we're going to do for the group is this one here, debit, dividend revenue, and credit investment. Right, you happy with that? Okay. This one here, do we need this one? Yes, we do. Why? Because it hasn't been done yet. Right? This one here, it has actually been done. Sorry. And that would have been done under the cost method, wouldn't it? When we received the money, under the cost method, we would have done this journal entry. Yeah? Okay. The next one. What do we have to change here? We've got a similar situation to this one here. Similar to that one, haven't we? Okay? We're wanting to end up with debit dividend receivable and credit investment, right? This is a journal entry that has been put through already. Yeah? Okay, so we don't want to do that again. Okay? So we've got to make a bit of an adjustment here. We want to cancel that out.
Dividend revenue
That's right.
and credit investment.
Okay, you happy with that? So if you put those two together, you end up with debit dividend receivable and credit investment. And that's what you're wanting. Why? Because these two cancel each other out.
Yeah, that's right.
Okay. This one here, do we need that one? Has it been done under the cost method?
No.
No, it hasn't, so we need to do that one. Right? And this one here, has it been done under the cost method? No. So we need to do that one. Can I just say that when you're actually doing for the group, the only adjustment that we, basically what we're doing here is we've got year 1 and we've got year 2 starting here, right? Okay. If I said to you that, okay, we're doing the consolidation adjustments to basically convert from cost to equity method, and we're doing it at the end of year 2. We're doing it at the end of year 2. Okay. Would we need to do for year 1 as well? Okay. Just remember that with consolidations, okay, just remember, okay, this is, we had P and S, right? You happy with that? And for the group, right? So what we had in the middle here was consolidation adjustment, right? Okay. Remember that whenever we did adjustments, they didn't change what was in P and S. So in other words, if we had to do consolidations at the end of year 2, what happened with year 1's adjustments? Did we have to put them in again? So in other words, what I'm saying to you, if you always start with P and S, and they have never been adjusted, in other words, these consolidation adjustments have never gone through P and S, and you're starting with P and S. So in other words, you've got for P and S and they've processed things for year 1 and year 2. And you know that in P and S for year 1 and year 2, they haven't eliminated any intercompany transactions, for example. Right? So what I'm saying to you, at the end of year 2, if you had to do consolidation adjustments, you would have to actually re-put in journal entries from year 1. Shall I repeat that? Okay. So if you're doing, so I said to you, end of year 2, doing consolidation, right? Would you kind of go, okay, well, year 1, we've already put those consolidation adjustments through. Would you